G'day and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's check what happened overnight. Global stocks turning deeply negative on US economic concerns after weak manufacturing data. Adding to the volatility on Wall Street was the Labor Day long weekend holiday, while many investors also returned from extended vacations in September, which is historically one of the worst months for equities. The S&P 500, NASDAQ and Dow all had their biggest declines since the sell-off in early August. The Magnificent Seven mega-cap tech stocks led the falls, with Nvidia tumbling more than 9%. In fact, its market cap was slashed by $278 billion, the worst ever market cap wipeout from a single stock in a day. Other chip stocks fell after UBS reported a drop in July semiconductor sales, with Advanced Micro Devices, Intel and Micron all down sharply. Tesla fell on reports that the EV maker plans to produce a 6-seat variant of its Model Y car in China from late next year. And rival EV maker Polestar rose as it named a former Stellantis executive as CFO. Boeing shares plummeted after Wells Fargo downgraded the aircraft manufacturer to underweight from equal weight. And the copper miners fell as red metal prices hit two-week lows on Chinese demand fears. US-listed shares of BHP and Rio falling as much as 5%. Well, the latest measure of US manufacturing activity shows it remains weak, although it has improved slightly from an 8-month low in July, and factory employment continued to contract, though the pace slowed. The ISM's manufacturing PMI rising to 47.2 in August, with a reading below 50, indicating contraction in the sector, which accounts for more than 10% of the US economy. Concerns about softness in the economy saw the yield on the 10-year Treasury note fall 7 basis points to 3.84%, and the 2-year fell to 3.86%. And the US dollar has risen to a 2-week high against the euro, as traders look to a raft of US jobs data later this week, which could shape the path of US interest rate cuts from the Federal Reserve beginning this month. The dollar also benefiting from a flight to safety as stocks and riskier currencies sold off. As a consequence, the Aussie fell more than 1% to 67.1 US cents. Well, let's get across what we're seeing now on global markets. Sam Ruiz joining us from Rowe Price. Sam, good to catch up with you again. Take a look. Let's first see what happened last night with very sharp falls led by Nvidia, as I said. And I guess what have investors taken that opportunity to just question again that AI thematic, given those dramatic gains we've seen this year?
Yeah, good morning, Andrew. I think that what we're seeing right now in the tech stocks that you've alluded to with Nvidia overnight, but even I'd say with the manufacturing data and the wobbles we saw in July, August, are all about expectations being reset. Now for Nvidia, in isolation, it's actually a stock that we've been reducing in our portfolios for a few months now. And the reason for that is there has been this huge inundated rush of CapEx from what we call the hyperscalers, the mega cap tech companies building data centers, saying we're going to invest in this generative AI, we're going to buy a lot of GPUs from Nvidia. The problem is investors now are thinking forward around what happens if Nvidia increases earnings in absolute dollars, but what happens if the additional new CapEx means that the percentage growth rates of Nvidia, and this isn't just about Nvidia, there's a whole supply chain of other companies that benefit it. It's utility companies, it's companies that might provide electrical components or even cooling technology for the data centers. I think people are sort of having those expectations reset, coming back down to earth now around Nvidia might actually not sustain those high growth rates. And if that peaks, then it means that the multiple, the valuation of the stock has to be reset even lower. And we were looking at 2025 where the market was probably thinking it might earn around $5 in EPS, and that's probably going to be closer to around $4 of earnings. So expectations reset, still a great company, still going to grow earnings, but probably expectations got a little bit ahead of itself.
And of course, we've seen the likes of Nvidia and the other Mag 7 stocks drive the market higher. It is that very narrow leadership. So as a consequence, when it comes off hard. What are we seeing that broaden though at all at the moment?
We are absolutely seeing that broaden. So this year you can see that the Magnificent Seven have actually beaten the S&P 500 in the US as an example. But if you take Nvidia out of that group, and let's call the remaining six the Mag 6, they've actually just slightly underperformed the S&P 500 on a weighted average basis. So that tells us that the market's becoming more discerning. There's some much larger winners and losers, Tesla being one of them you alluded to, still finding weakness overnight. But I think that the fortunes of these companies that used to be much more of a correlated basket and this AI trade are now being more focused on fundamentals, and we're seeing a lot more discernment. So definitely broadening.
So Sam, when we head towards the first US rate cut, which obviously is expected the week after next, when the Fed next meets, what do you expect that the market, how it will respond? And I guess it comes down to the size of that cut, doesn't it? If they go 50, perhaps there's some concern about a recognition of some weakness in the US economy.
I think that's the perfect way to frame it, because we've been saying for about 6 to 9 months now the market can't have its cake and eat it too. So the market's basically saying we're going to see this miraculous pullback in rates, the economy is going to continue to be strong, earnings growth is going to be double digit next year, even against that backdrop of very large rates and the economy not weakening, even predicting less defaults. So credit spreads have actually been tightening. So we would say that I think a mild tone of rate cuts is good, and you don't want too much so that the economic health starts to come into question. But there's been some distinct laggards in the market, one of them being small caps, and you would have heard a lot of different fund managers on this channel basically saying that's going to be great for their financing costs and even some of the multiples that can re-rate. But another area that we're actually thinking has the potential of seeing a very big sentiment modifier from rate cuts is actually emerging markets. So EM in general tends to suffer when interest rates and the US dollar are strong for prolonged periods of time. But if we expect that to revert, now specifically, I'll just clarify, EM tends to come under the cloud of China, because China's been very weak and people question what's happening there. But if you look outside of China, we're actually seeing strong earnings growth. Some of the strongest earnings revisions this year have actually been in EM ex China. And if we expect the US dollar to weaken, then we actually think that that could catch more of a bid, and there's some really great opportunities in emerging markets.
So specifically, Sam, then where are you looking when you talk about emerging markets ex-China?
So for us, it's not Latin America, it's not plain commodities, it's actually more where we're seeing the strongest demographics and structural tailwinds. So India and Southeast Asia have typically been where the majority of our emerging market companies have been found. India has been quite a hot market. Valuations remain quite elevated. So that's one that we still own, but we haven't been leaning into. We've actually more recently been leaning into Vietnam, Indonesia, and Philippines. And I'll just call out Vietnam as a great opportunity that's very much off the beaten path. A lot of people wouldn't know this, but it's a population of around 100 million people that's right on the border of China, very well set up to manufacture. So Samsung actually employs more than 100,000 people in Vietnam to make a lot of their electrical products. But they're actually positioning themselves now to be more of an AI tech hub. And even Jensen, the CEO of Nvidia, announced around $250 million investment into Vietnam recently. And part of that's actually going to be targeted towards a company that's one of our highest conviction holdings at the moment, called FPT. So there is a great opportunity for them to take share from China when the rest of the world is trying to retool. But I would just say Vietnam's more ahead when it comes to technological innovation than people anticipate. And in the past, what was about manufacturing textiles and low-value goods, in the future is going to be more about high-value products, which should see the country continue to benefit.
You mentioned one of those stocks, FPT Corporation. Tell us a little more about that and why you like it.
So FPT is one of the largest and leading tech companies in Vietnam. Now what they do is they help other companies, predominantly outside of Vietnam, to integrate IT into their business. So whether it's about a company coming to them saying, we want to use this artificial intelligence thing, how do we do that? Whether it's them saying, we want to move our data from on-premise to off-premise to the cloud, how do we do that? So they'll insert consultants, they've got coders, and as a fun fact, the coders in Vietnam are around 90% cheaper than coders in the US. They're also about 15% cheaper than coders in India, which is a very strong outsourced market for IT. But what Vietnam has is a very young, well-educated population, and while FPT's been a great outsource partner, they haven't had historically the number of educated people in technology and coding to be able to outsource at scale. What they did that was really smart, they actually opened FPT universities. What they're doing now is they're funneling a lot more people from their own population into tech degrees. One of the big outsourced markets they have, you might not even guess, is actually Japan. So if you go to FPT University, you become a qualified coder, a qualified tech specialist, you get educated in how to speak Japanese, and all of a sudden at the end of your degree, you're funneled into the FPT IT business with a great wage. and then they're increasing their talent pool. So as one last fact there, since about 2017 to 2023, the full-time employed students in FPT was about 9,000. That's now grown to just under 150,000. So the funnel of talent that they're bringing through the university, which then becomes an employee base, is dramatically going to increase their scale.
How wary should be of sovereign risk in Vietnam?
Sovereign risk, so in Vietnam, they've got a very pro-growth, sensible government. So one thing is they're not doing this in sort of a China debt way, which is great. They have the most free trade agreements of any country in Southeast Asia. It's around 18 free trade agreements currently, potentially going to 20. And you actually had Biden there a couple of years ago, maybe even last year, basically signing new trade terms with Vietnam. So I think that Vietnam is leaning into the fact that the rest of the Western world wants to untool supply chains from China and move it to a geographically close location, which is Vietnam. So there are other risks, I'd say, beyond sovereign risks. It's a frontier country, not even classified as emerging market yet. So there's corruption risks. They had a big corruption scandal in the property sector last year. So it really then becomes, for an investor, a market that you can benefit from all the things I mentioned, but not by playing the broad index, because the broad index is going to have some of those emerging risks that these countries tend to have. And you really need to do your due diligence around where you put your money behind the right companies with corporate governance, etc.
Sam, terrific to get what you view as some opportunities in emerging markets, particularly with a focus there on Vietnam. Thanks so much for joining us on Rowe Price.
Good to see you again, Andrew.
Quick check of the local market when we get underway in just a couple of minutes' time. No surprise there that we're looking for a deeply negative start. SPI futures there off close to 1.2% following those moves we saw on global markets overnight. Stay with us because the open is just a couple of minutes away.